A new study of the mortgage industry has added to the increasingly gloomy sentiment about the outlook for banks. According to JP Morgan and Fujitsu Consulting, growth in home lending will stay subdued for the foreseeable future, meaning banks will have to become creative to maintain their profit margins. Andrew Robertson reports.
Australian bank profits are heavily tied to mortgages. Mortgage growth has averaged more than 10% over the last couple of decades, but if last year's fall is any guide, those days are over.
We think growth will be lower for longer, so banks do need to look at the profitability of their existing book.
And to do that, according to JP Morgan and Fujitsu Consulting, banks must learn more about their customers and offer their products in a different way.
Up until now, essentially, most organisations have been developing products, pushing them into the marketplace and competing on price. With top-line growth coming away, now people have to realise that not all customers are equally valuable or equally interesting, and therefore you need to tailor and target your propositions much more carefully.
It's called customer segmentation, and JP Morgan's Scott Manning believes the big four banks are already well down that path as they try to capture an increasing share of a shrinking mortgage market.
We've seen Commonwealth Bank lead the charge with $1.1 billion investment in their core IT platform. That'll give them better identification of their customer base to be able to target specific offerings to specific customers so they don't over-service poor customers, but at the same time identifying profitable customers. We've seen National Australia Bank undergo their next